The Walt Disney Company is reporting on its latest quarter to investors, and the numbers are not good. The mainstream, lamestream media largely refusing to report just how bad it is, but that's where I come in. Get ready, folks, because yes, it's not a guess. Disney's entertainment division dropped 35%, and total revenues significantly missed Wall Street expectations. Hello, ladies and gentlemen, welcome back to the channel that continues to give you the truth with a capital T, served on chatter of platter every single day. Now, I'm not here to tell you what's going to happen with the Disney stock today. That's not my job. That's not what I should do. I don't want to become Jim Cramer 2.0, but I'm going to give you the details that the mainstream dinosaur going extinct media refuses to tell you, and we're going to do it with a zeal that even the Holly Weirds can feel. All right, we're going to go to the Hollywood Reporter. As you click that like button, Alex Weprin is the author here. And we love Alex. I think Alex does a great job, but I also think that there is massive pressure this morning from the Hollywood trades who are in a total industry freefall to do everything they can to save Disney. The headline is not, it does not reflect what a dismal day this will be. Disney Plus streaming subscribers surge by 3.8 million as streaming profits grow is the headline. Can I show you how it's being reported in a few other places, aka the financials? If we go to Yahoo Finance right now, what is the headline? Disney Q4 revenue misses estimates amid linear TV pressures. Company increases dividend. Now, why is Disney increasing that dividend? Well, folks, it's probably increasing the dividend because what else can it do? There are no free theme parks being announced this quarter. It says the full subscriber cancellation impact of the Jimmy Kimmel backlash won't be felt next quarter, which is to say there either was no backlash ever, it was completely made up to pressure Disney to put Jimmy Kimmel back on, or these people just didn't know what was going on and didn't realize, oh, Disney won't report that in this quarter. Here's what you need to know, though. I'm going to skip some of this stuff, and I will come back. I'm not trying to cherry pick. I'm not trying to hide. I'm telling you, this doesn't matter nearly as much as what we need to see down here, okay? I promise you, because buried down under here is the real deal. Cord cutting, it says, also impacted the company's linear TV business. I promise. I'm going to go back up. I'm not playing a switcheroo on you. The trades are. You'll see. Which saw revenue declines of 16% to $2.1 billion, and operating income fall by 21% to $391 million, okay? So linear TV, that's ABC, that's ESPN, that's, I guess, the Disney Channel is still out there somewhere. Those items are failing. Overall, though, and this is what you need to see, this is what they've buried down 5 or 6 paragraphs down into the article. Will shareholders fall for that? I don't know. Overall, the entertainment division, inclusive of linear and streaming as well as studios, all of entertainment, had revenue of $10.2 billion, down 6%. Disney dropped 6%, but get ready, whoa, Nelly. And operating income, that's a fancy way of saying profit without some of the, there are a few additional fees before it just becomes profit, but it's essentially profit. Income of $691 million, down 35%. Now, what you need to know is, the Walt Disney Company is valued at over $200 billion. If all of entertainment, 1/3 of the company, brought in a profit, before some additional fees are taken out, brought in a total profit of under $700 million in a quarter, for a company that's over $200 billion in size, that is terrible. A 35% decline. Now, what is a 35? How do you get to a 35% decline? Terrible box office returns, but also something's not right in streaming, and I've sniffed it out. I'm going to show it to you. All right, see, I told you I'd go back to the top. Let's go back to the top now. Now that we know where we're going to go. And by the way, revenues, total revenues, I'll just go ahead and skip this. Spoiler alert for this last quarter. Total revenues for the Walt Disney Company, coming in 5% down for the quarter and missing Wall Street expectations. So, however THR wants to spin it and these others, it's not good. And I'll show you how they're spinning it in just a minute. Streaming continues to become a more potent force on the Walt Disney Company's balance sheet. Well, yeah, because if every other part of entertainment fell, that would make it be bigger, right? If you shrink the size of the pie, then the slice that stays the same is, well, okay. Anyway, Disney released its latest quarterly earnings early Thursday morning, reporting revenues of $22.5 billion, flat from last year, and segment operating income of $3.5, down 5% from a year ago. So they dropped 5% profit from a year ago. Now, at the same time that inflation is rising, if you stay flat on revenues and if you're down 5% in profits, it's actually far worse than that. While Disney is still feeling the pinch of linear TV troubles, its streaming business continues to grow. Most notably, the company beat Wall Street estimates with Disney Plus subscribers rising by 3.8 million compared to the same quarter last year, and Disney Plus and Hulu subscribers rising by 12.4 to 196. All right, smoke and mirrors again, folks. I'm going to tell you what this is. Disney is giving away Disney Plus to charter subscribers. Okay? That's how that worked. Disney cut a deal with charter subscribers to give away free Disney Plus subscriptions to charter subscribers. So, there's your 3.8 million freebies, right? But here's what you need to see that should be concerning to shareholders, investors, and Disney. It says Disney Plus and Hulu subscribers rose by 12.4 million to 196. And as you all know, Disney Plus and Hulu are now so integrated that if that is double counted, don't count me surprised, but 3.8 million rose to Disney Plus. Wouldn't that mean then that just about more than 8 million went to Hulu? What that means, ladies and gentlemen, is Disney Plus, they can't give it away for free. The growth is in Hulu, not Disney, and that's a brand problem. Direct-to-consumer revenue rose by 8%. That's streaming again. The revenue rose by 8%, but operating income, that's profit, rose by 39%. Now, they're crowing about that, but there's something very important to note about it. 8% growth in total revenue. Listen, they just grew by how many subscriptions? They just grew by how many subscriptions? And revenue only rose by 8% at the same time that they increased the cost of Disney Plus and Hulu by how much? How much? Oh, just about 8%. Do you know what the giveaway is here? The giveaway is that they're giving away these subscriptions. Okay? That's my claim. That's my opinion. Speculation, please, but you do the math and you see if I'm true. 8% growth. They increased the cost of Disney Plus and Hulu in the same quarter, and they cracked down on password sharing, but they only increased revenue, total revenue, by 8%, which would seem to be that if you kept the subscriber numbers exactly the same as the last quarter, that would have been 8% growth just based on the increase of the subscription costs. Yet, they also say that they grew in total subscribers. So how can that be? Seems to me that it's proof positive that those are freebies. Those subscriber numbers, they don't matter. This is the last quarter that Disney's going to release those subscriber numbers, and they needed it to look good. So, do whatever you can to get those sub numbers up. Now, Netflix does the same thing in terms of not reporting subscriber numbers anymore, but the reason for that is very different. Netflix has stopped giving the subscriber numbers because it's no longer their focus, because they've reached saturation points for the United States. In other words, Netflix is in so many households, they don't really have anywhere to grow in that regard, so they got to grow the revenues. Disney is going to stop reporting the subscriber numbers because they can't catch up with Netflix. And that's how you get this almost 200 million subscriber nonsense, which frankly is because they have two services rolled into one, Disney Plus and Disney Plus and Hulu. Many of you out there have both of those because they're integrated and they're counting them both, I believe. Says those subscriber numbers are still somewhat surprising, given that Disney had two events in the quarter that could impact subscribers. Talks about Jimmy Kimmel, that's such a nothing burger. If there was a loss, it's because of what he said. And guess what, folks? Guess what? They were never going to count those cancellations if they happened this quarter. They were never going to count them. They roll them into the next quarter when they won't call out the subscription levels. What about the parks? We talk about the parks here. Disney Experiences business also continued to chug along with revenue of $8.8 billion, up 6%, and operating income of $1.9 billion, up 13%. And that's about it. They don't want to talk about it anymore. You know why? Because if you're up 6% on revenue, that would be just ahead of inflation, right? That's just above inflation. No commentary here on attendance or any of that kind of stuff, just up 6%, which if you've raised the cost of food inside your parks by 10%, and you've increased the cost of some other stuff inside your parks, wouldn't that cover that 6%? It might even cover it if you had an attendance decline. Just throwing that question mark out there. 6% revenue growth, if you're increasing prices, doesn't mean that you're having real growth. It means that you're sticking it in the short term to your customers. Operating income, and here's how we know about this. Operating income, that's profit again, up 13%. How did they go up 13% if revenues went up 6%? Well, because they stopped spending. So that means when you're talking about theme parks, the experience business, right? This doesn't have to be the case in every industry. Sometimes you can pull this off, but in theme parks, if you're cutting costs, which must be the case here in order to get the profit up higher than the revenue, if you're cutting your expenditures, you're cutting likely experiences in Disney's experiences business. And sports, which is anchored by ESPN and is 1/3 of Disney, saw its revenue rise by 2%, not keeping up with inflation, and operating income fall by 2%. That's profit as cord cutting continues to wreak havoc. Now, wait a minute. I thought this was the grand opening of the ESPN app. We should have seen tons of cash come rolling in, but we don't. Oh, no. Now, what is the saving grace here? What's Disney going to try to say that should keep shareholders? And I don't know. Again, folks, the stock could skyrocket. It could collapse. It could go anywhere in between. It all depends on what narrative shareholders and investors and the big ones decide to go with. The company released guidance for fiscal 2026 and early guidance for 2027. In 26, the company expects double-digit segment percentage operating income growth in its entertainment business and within the operating margin of 10% for its entertainment direct-to-consumer business, yada, 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 yada. What does it mean? It means that Disney didn't do well. They're throwing out a higher dividend, which you can see here. They didn't do well. This is a bad quarter. This is a flat-out bad quarter with no big announcement that I see to save them. And so Disney's play, as they go into Bob Iger's final year, is to say, hey, stick with us. It's going to be a good one next year, even if we didn't do what we said we'd do from the last year. Here's the quote from Bob Iger. This was another year of great progress as we strengthened the company by leveraging the value of our creative and brand assets and continue to make meaningful progress in our direct-to-consumer businesses. Our strategy, coupled with our portfolio of complementary businesses and a strong balance sheet, enables us to continue investing in high-quality offerings for our consumers and increasing our returns to shareholders. And I'm pleased with many of our achievements this fiscal year to position Disney for the future. And that is the play today. They need to tell you that it's all about the future. And why? Because it certainly is not for today. All right, let's go to the Google News reports. Let's see what they're saying out there in Wall Street land. Folks, here's how it's being reported. I'll show it to you. If you search for this, top news. Let's see here. Wall Street Journal is reporting it this way. Disney posts roughly flat quarterly revenue as TV declines continue. Disney didn't post a roughly flat quarterly revenue. They dropped 5%. Yahoo Finance, you've seen that. Disney misses estimates. The Los Angeles Times is claiming this is on weaker theatrical results. That is partially true. Variety says Disney quarterly revenue flat and operating income, that's profit, drops 5%, but company affirms bullish earnings outlook. And Market Watch says streaming drives the way for Disney. I mean, an otherwise mixed earnings report, and I've already shown you, that streaming stuff is a bunch of fluff. So, I don't know. Usually when you search through this, usually you get a lot of glowing kind of commentary. You know what? I tell you what, let's look for Deadline Disney earnings real quick. You ready for this? Let's see. Deadline Disney. Let's see what they've got. Disney tops streaming expectations and final subscriber report. Quarterly results otherwise mixed. Okay, but they go off with something positive. They got to get ahead of this a little bit. We'll search for Variety Disney. Let's see. They don't have... Oh, yeah. Disney adds 3.8 million subscribers. Hulu packs on 8.6 million amid Kimmel controversy in September quarter, failing to tell you that the cancellations wouldn't count. So there you go. Now, folks, we know them better than they know themselves. We can predict what they're going to do even before they do it. How will shareholders respond? Well, folks, I'm no Jim Cramer. I'm not going to tell you that. But now you know what's happening. Folks, that's where we'll leave it at. We've got more stuff on the way. The Pro Show live today at an earlier point as we continue to point our finger at the Walt Disney Company. No, not that finger, the other index finger. And we've got our finger on the index of the company. Folks, until the next time, keep learning, keep growing, and keep having fun.
Okay, these colors just seem to conflict with your natural tone.
Wilton, what are you doing?
Obviously, we're getting Jose ready to throw his name in the hat to be the next CEO of Disney.
That's ridiculous. He's not qualified for that kind of role.
Well, of course he is. He's a wonderful candidate for a corporate puppet.
What on earth is happening?
He's literally a foreign agent by all accounts. You think honoring boundaries is a thing? No! This is Disney! He's got diversity points, green skin, and a wig. And most importantly, he likes to destroy things and blow them up, whether they're from the past or from now. He shows no discrimination.
Okay, you know what? I really can't argue with any of that. So,
right?
You two have fun. I'm gonna go read thatparkplace.com and watch WDW
Okay,
Pro.
bye. Okay, Jose, say magical experiences.
I already hate this.